If you currently are considering a SEP IRA or a solo 401k, then you'll want to watch this video to learn about some of the pros and cons of each and how you can get them set up. Welcome back. This is episode 182. In this week's episode, I am talking small business retirement plans, and specifically talking about a SEP IRA versus a solo 401k plan. In last week's episode, I talked about how you can separate your after-tax money from your retirement accounts and move it over to a Roth IRA to benefit from tax-free growth on that money. And if you haven't listened or watched last week's episode, please check it out. And one of the options that I mentioned as far as getting this done was setting up a solo 401k to roll your pre-tax money into. And I'm going to talk more this week about a solo 401k and a SEP IRA as far as how they work, what their pros and cons are, and how you can set one up. But before I address this, I need your help to continue to grow the reach of this show. If you haven't subscribed to my YouTube channel, please do so. If you're watching, if you're listening, if you could head over to YouTube and log in and then search Retire with Ryan podcast. From there, you can find my YouTube channel and subscribe to it. Really appreciate that. As a small business owner, you have various options to set up a retirement plan. And whether you're running this business full-time, whether this is a part-time business, or you just receive occasional 1099 income, you can reduce part of your taxable income and save for retirement by contributing to a retirement account. And specifically, we're going to talk about a SEP IRA versus a 401k. However, I always should mention that if you're looking to save $7,500 per year or less, and you have no other retirement plans available to you, you can simply contribute to a traditional IRA and also simplify your life at the same time. And $7,500 is the contribution limit to a traditional IRA or a Roth IRA for someone over 50 for 2023. However, if you want to save more money than that, and possibly be able to borrow from this account, then you'll want to keep listening or watching. First off, what is a SEP IRA? SEP or SEP stands for Simplified Employee Pension, and it's a retirement account that allows you to contribute up to 25% of your net business income with an annual limit of $66,000 for 2023. And that annual limit goes up to $69,000 in 2024. And a SEP allows for employer contributions only. And if you're self-employed, you're limited then to contribute 20% of your business net income or net profit. And you're generally considered a self-employed individual or person if you're a solo proprietorship, a partnership, or a limited liability corporation or LLC. You're generally not considered self-employed for all other business structures, including partnerships and LLCs that are taxed as corporations. A solo 401k, as it sounds, is sometimes called a uni-K, is a 401k plan for just one person. Or if you and your spouse both work in the business, you can still have a solo 401k where both of you can be able to contribute to it. And solo 401ks allow for the same contribution limit of $66,000 in 2023 or $69,000 in 2024. However, the big difference is, or one of the big differences is that they allow for both employee and employer contributions. The employee contribution limit for 2023 is $22,500 with a catch-up contribution of $7,500 if you're over 50 for a total contribution of $30,000. You've heard me talk about this before. You're probably familiar with it. And the contribution limit for 2024 goes up to $23,000 with the catch-up contribution staying the same at $7,500 for a contribution limit of $30,500. However, the solo 401k also allows a profit sharing or employer contribution of up to an additional 25% of your net business profit income or 20% for self-employed individuals up to that same contribution limit that I mentioned before in 2023 of $63,000 or in 2024 of $69,000. So as a self-employed person, you can make both of these contributions. By allowing employer and employee contributions, this allows a business owner to potentially be able to contribute more to a solo 401k than a SEP IRA. Let's say, for an example, a 50-year-old business owner under a C Corp has net business income of $125,000 in 2023. Now, as I said before, net business income is essentially the profit of the business income after expenses. For this business owner, they could contribute 25% of that $125,000 into a SEP. That would be $31,500. That would allow them to reduce their taxes by $31,500. If they set up a solo 401k, they could contribute the employee deferral maximum, which, as I mentioned before, would be $30,000 in 2023. And then they could also contribute 25% of their net business income, which is $31,500, as an employer or profit sharing contribution. This would then bring their total contribution up to $61,500 for the year. And that is one reason why a solo 401k can be more appealing than a SEP IRA. If you're looking to put a lot of money into your retirement plan, you've been maybe reinvesting a lot back into your business, which is great. That's a great way to grow your business. But now you're ready to start saving for retirement, or you just got a late start on saving. This can be a great way by using a solo 401k with a profit sharing plan. Now, I should let you know that if you are considered self-employed and not a C Corp or a corporation, the calculation isn't as straightforward as just taking 20% of your net business income. You must factor in self-employment tax into the calculation. I know I'm going to lose some of you here, but bear with me. You must first deduct 1/2 of the self-employment tax from your net business income. You then multiply your contribution rate by that number. So in our example, let's just assume that same 50-year-old business owner was set up as an LLC instead of a C Corp. He or she would first subtract 1/2 of self-employment tax, which in our example would be about $88,000, roughly 7% of business net profit. Then multiply that number by the 20% contribution profit sharing maximum. And in this example, this would result in a maximum contribution amount either through a SEP or a profit sharing contribution of $23,234. And they would be able to do the same in either one. However, the solo 401k, as we mentioned before, allows the employee contribution maximum of up to $30,000 in 2023, even for someone who's self-employed, bringing then the maximum contribution up to $53,233. So that $30,000 more than the SEP IRA. So I put a link in the show notes if you want to see the details of this, to see how this number is calculated. I put a link in both the IRS information as far as how the IRS tells you that you have to calculate this number, as well as a link to a free calculator where you can actually walk through how you would do this. And if you go to www.retirewithryan.com/podcast/182, then that'll take you directly to this podcast episode where you can find those links. So now that you know some of the basics of how these accounts work, let's just recap the pros and cons of each plan so you can get a better idea of which one might be right for you. So let's start with SEP IRA pros. As we mentioned, you can set aside up to 20% of your net business income, or 20% for those who are self-employed. These plans are easy to administer and set up. Usually you just have to fill out the paperwork at the custodian that you're going to be keeping the account, and it's set up. There's not a calculation that you need to do, or a complicated calculation, I should say, to make your contributions. It's relatively straightforward. And on an ongoing basis, there's not a lot of work that you have to do with them. So let's talk about SEP IRA cons. As we mentioned in our example, they are limited to that 20% of net business income, or 20% for those who are self-employed. They don't allow for employee contributions. So as compared to a solo 401k, usually the contribution limit is going to be less. You have to contribute the same amount per employee, meaning that if you later hire employees and you still have a SEP plan, you're going to have to, whatever you put in for yourself, you have to put in for them. So if you put in 10% for yourself, you have to put in 10% for them. you might want to do that, but that's a lot of money to contribute for an employee, and that might be rather difficult to keep up with. SEP IRAs don't allow for loans. You're never able to take a loan. You can take withdrawals that might be taxable, but you're not able to take loans. There's no catch-up provision for those people 50 and older. There's just that straight percentage contribution. There is no Roth IRA available. So there's no Roth SEP IRA, so that if you happen to make more than is allowed to make a traditional IRA contribution, you can't make the traditional Roth contribution. A way around that would be going into a Roth 401k, but SEPs don't offer that. And if you're trying to do a backdoor Roth IRA contribution, SEP IRAs will make that difficult to do, as they'll be part of a prorated calculation. So let's move on to solo 401ks, talk about the pros. They allow for employee contributions without a percentage limit, up to that $30,000 limit for 2023. They allow also for an additional 25% or 20% contribution limit of a profit-sharing contribution for self-employed individuals. They allow a catch-up provision for people aged 30 and older, age 50 and older. They offer a Roth version. If you don't want to take a tax deduction, but you want to get money over to the Roth side, you can set up a Roth 401k with your solo 401k. And they allow for loans up to half of the plan balance, or $50,000 of total loan, or whichever number is less. So if you have $150,000 in your 401k, you need to take out a loan, your solo 401k, you could borrow up to $50,000. Now, granted, you're going to pay interest, but you're paying yourself back interest. However, if this sounds like the solo 401k is a better fit for you, before you do that, just be aware of a couple of the cons with solo 401ks. One is that if you have more than one employee other than a spouse, you generally have to include them in the plan, which means it will cease being a solo 401k plan. Usually when someone has worked for you for 1 year and they work more than 1,000 hours per year and they're age 21 and older, they have to be included in the plan. If they don't meet that criteria, then you can set your plan up to exclude them. And at this point, once they qualify, then they'd have to be included, so you'd have to switch over to a traditional 401k plan. And that will usually increase the cost, the annual cost of maintenance or administration, as well as make it more difficult to administer and maintain than a solo 401k. Doesn't mean it's not still worth having, but it's just going to be a little bit more difficult. And then another big con is that once the plan gets above $250,000 of assets, or an employee qualifies for the plan, you have to fill out some additional government paperwork called a 5500 form, and they're due every year at the end of June. Now, they have to be done on an annual basis, and it's not as scary as it sounds. You could definitely do it yourself once you get the hang of it, but initially you'd probably have to hire someone to do it and make sure it's filed correctly, or else you might have to pay fines and fees. So this doesn't occur with a SEP IRA. So there's definitely pros and cons to these plans, and it's a good idea that you consider them anytime you're looking to contribute into one of them. So where can you set these up? Many companies offer these retirement plans, and both SEP IRAs and solo 401ks are available with many of my personal favorite companies or personal favorite custodians. That would be Charles Schwab, Fidelity, and Vanguard. All of them offer them. You just need to complete their paperwork in order to open them. And I believe in Schwab and Fidelity don't charge an annual fee to have them open and be there on an annual basis. However, Vanguard charges a small annual fee for solo 401ks if you're below $50,000 in balances, and I believe they charge a small fee if your SEP is below $10,000. I personally have my 401k plan at Charles Schwab. I started it with TD Ameritrade as a solo 401k before the merger, but have since moved it over to Schwab. And it's now a 401k because I have employees. And the only difference is that when you add those additional employees, you have to add some additional paperwork on file. And you need to be updating what's known as your plan document. That lays out the rules for your plan as far as who can contribute, how much they can contribute, if they can take loans, if the plan accepts rollovers, if there's a profit sharing plan, if there's a vesting schedule. There's a whole host of things that you can customize your plan with. And you can get a somewhat customizable version of this if you want to use a company like a Census. That's what I use for some clients, and they charge a $250 annual fee to help you maintain this plan document every year. So it's still relatively small, but you can take it a step above that and hire what's known as a third-party administrator, or a TPA for short. And usually for about $1,000 a year, they'll help you with the annual administration of your plan, keeping your plan document up to date, filing your Form 5500, and making sure you're staying on top of things. So if you're somebody who doesn't want to be having to deal with this or be hassled by this, but you still want to maintain a 401k plan, you can consider using a TPA. And there's also many other 401k providers as well that we don't have time to cover. But if you are just setting up a solo 401k, it's relatively straightforward. However, when you do add employees, it can be a little bit more challenging to administer, but it's definitely something you can do. So I hope this was helpful. I'm giving you some information about a SEP IRA versus solo 401k. If you enjoyed this episode, please leave me a comment or subscribe below. And as always, if you have questions and you'd like to have them considered for a future episode, please head over to retirewithryan.com and click on Ask a Question. Have a great week, and I look forward to talking to you next Wednesday. Take care.